Hello traders, it's Bruce Banks and we're going over volatility, market liquidity, and how they interact when you're trading. It's a really important topic to understand as it can end up blowing up a lot of accounts, causing you to have slippage in your trade orders, and is generally something that's important for you to understand. So first we have to discuss them individually and then we can combine them. Volatility. Volatility is the price movement in the market or how much the market is actually moving. It can be seen directly on your charts by simply looking at how quickly the market is moving through certain trading areas. And we take a look here on a 60-minute chart, and we can see that in this area, we're only looking during the trading day right here, there is more volatility than in this area. These are two separate days, and the day one here is less volatile than the second day here. We look back another day, and we can see again, it's less volatile. And the one prior to that is somewhere in between the last one and these other two. So what can we compare volatility to? Well, volatility can be compared to the weather, saying that an average day is a nice sunny day. And then even on a sunny day, though, you can get, say, a hailstorm. A hailstorm, it would be a large movement in the market, either up or down. That's when there's a lot of volatility in the market. There's a lot of uncertainty over what's going to happen. That could be uncertainty over, the farmers are worried about their crops. People are worried about their cars. If they get damaged, they have to go through insurance. It becomes a big hassle. Things like that, like in the weather, are volatile. If you get a freezing cold day, it can cause problems, more traffic accidents. That is more volatile time. So in comparison to the markets, a more volatile market is when there's more uncertainty in the market generally. So when there's more uncertainty, there's often sharper moves. I'm actually going to bring up a clip from a post-election trading day. This is the day right after a presidential election in the US. And you can see that there are multiple times that I'm showing where the volatility spikes because there's a lot of uncertainty in the market. High volatility doesn't always have to be spikes down in the market. It can also be spikes up in the market, or even quick in succession spikes up and spikes down. Volatility is just a fast-moving market. It can be caused by events such as news related to your commodity, world events such as elections, like the one that's being shown right now. Wars being announced can affect certain prices in stocks quite dramatically, as companies that could benefit from the war may jump up. Companies that may suffer from a war will drop down. It can affect currencies in that way. The countries, it might increase the instability in certain countries, causing their currency to drop. And more commonly, you're going to see is it can be caused by scheduled news announcements. So say after there's a specific news announcement with a company saying bad earning reports, the volatility in that company will increase, most likely to the downside, because all of a sudden there's a lot of traders that see this particular company and are like, oh, okay, well, bad earnings report might mean a bad future outlook, and therefore the stock might be worth less. There's going to be more volatility in the market. It can also be caused by things like algorithms. When an algorithm goes bad as well, it can be caused by a whole host of reasons. All it means is the fact that there's more movement in the market. There's more uncertainty on the price, and therefore there's more volatility in the market. Some of these things we can't predict, such that we would need insider trading information to actually know before these events happened. And some of them can be avoided. Much like watching a financial calendar can give you warning in advance of possible large impactful events on whatever commodity, forex, cross, or stock that you're trading. Generally, we want to avoid high volatility times because these can often be very thin with trading and can cause us troubles such as slippage or not being able to get into a position. Volatility is quick movement in the market, up or down. Now, liquidity. Market liquidity is the amount of traders looking to trade at specific levels Therefore, how easy it is to purchase or sell without making large change in the price of that market. Think of liquidity in the terms of baseball cards. I could get an extremely rare card that is worth a lot of money, say $100,000. But the amount of people that are willing to buy that card for that price is very low. There's not a lot of people out there looking to trade a $100,000 baseball card, at least I think. There's low liquidity in the market. There's not a lot of opportunities to sell that card for $100,000. Now, what if I really want to sell this card? Now, I might not be able to sell this card for $100,000. What I can do is I can drop the price, and all of a sudden liquidity will come into the market. Say I drop the price to $50,000. I cut the price in half. All of a sudden, there are droves of buyers in the market for that card at the new deflated price. I brought liquidity back into the market. We can take this analogy and look at a chart and then start understanding the relation between liquidity and volatility in the market. We'll take this area here. Now, there's volatility coming into this market. There's lots of buyers looking to buy, but unfortunately, there's not a whole lot of sellers for them to match their trades. The sellers have dried up in this market. And so all of a sudden, every time you wait, say a minute, 2 minutes, 10 minutes, 30 minutes, the market price continues to go up. There's a lack of liquidity at certain levels of trading. Now, that's in direct contrast to an area like this, where you have a decent amount of traders both willing to buy and sell throughout this particular trading day. Now, keep in mind on this chart, we have it easily marked out so that every one of these blue boxes here represents one trading day. This is a weekend right here. So you're going to see volatility spikes in this market until liquidity comes back in. So we see a volatility spike here. So the market starts rocketing down until the bottom, when eventually the market bottoms out. It bottomed at the end of the trading day here, and liquidity started coming back into the market. There's more traders willing to make trades at this position. Now, not to say that the difference between the very top and the very bottom, there was no liquidity in the market. There were many, many trades being made, both buys and sells. The sells were pressuring the market downwards. There were more sellers than there were buyers in this market. But you could say on a day like this that there's less liquidity in the market. If you want to put in a lot of sell orders, it's hard to find a consistent price for them as the market is continually being pushed down. By definition at that point, very hard to find a consistent sell price for this market. Therefore, there's not much liquidity in the market. Similarly, but to not such a great extent, you have it on a day like this. There's less liquidity in the market for people that are looking to buy. If you wait very long in this day, the chance of you being able to get the same price for this future is extremely low. Liquidity will always balance back and forth. Volatility and liquidity will always kind of balance themselves out in the market. As the volatility increases, the volatility will increase until a quote-unquote fair price is reached, and then liquidity will increase at that point. The fair price is when traders start agreeing, saying that, say, 50% of traders want to sell this future, stock, forex, cross, whatever, and the other 50% want to buy this market. And if we look back, all charts are this balancing of liquidity and volatility. You'll see areas like this that have very, very high volatility. Movements like this are often news related. Buyers in this market got a bit scared and they just weren't willing to buy this market. The sellers got in control at this point and the market rocketed down. But there's always going to be a bottom. On certain stocks, well, that might be zero. Even on anything, you could eventually say there's a zero hedge on it all. In the end, everything is worth zero. But you'll see volatility increase until liquidity comes back into the market. And liquidity comes into the market, there's a lot of agreement between buyers and sellers that whatever price the market has reached is quote-unquote fair. And at that point, there will be a decent amount of buyers and sellers in the market, and liquidity will return to the market. You'll only see these shifts in high volatility to high liquidity markets. Sometimes within one day, sometimes it can take long periods before the markets actually balance out and find their balance point. Now let's talk about actually trading during these times. Now, it's always going to be a bit of a mix. As a home gamer and a home trader, you have a little bit more of an advantage over certain big money managers. Because if you want to enter a trade during a point of, say, medium volatility, you have that ability. We'll find in most high volume markets, if you only want one or say even 5 contracts, you're going to be able to find someone to take the opposite end of the trade. Whereas if you're looking to trade large sums of large amounts of contracts at one time, you have to wait for areas where there's high liquidity. Otherwise, you purchasing will actually affect the market itself. When there's less liquidity, you have to be worried if you're doing large amounts of trading that you're going to affect the market's price. And, say you want to get in on a price of, say, 1900, and there's a very low liquidity right now that the market thinks that this is undervalued. You want to put on a large position. The price difference from the first contract that you get to the 50th one might be an extremely large number because you put in so much volume into this market during a low liquidity time. Whereas if you look at a day, this day has both. So we see here, as a large trader during this day could get a fairly stable price on whatever amount of contracts he wanted. But say at the end of the day, when the market spiked up, during this time, there wasn't much liquidity in the market. This is a very sharp move up, and if you wanted to get a large amount of contracts, the difference in price between those from if you started buying the beginning of this candlestick towards the end would be absolutely massive and very difficult to trade. Like I was saying, one benefit of the home gamer or home trader, if you're not trading a lot of contracts, you're only going for one. So if you get the correct price on that one contract or 2 contracts or 3, you're still in a good position. You can still trade that market. Whereas someone that's managing a lot of contracts or a lot of money doesn't have that ability. Then there are times like this where we're getting quick spikes down in the market. And as a trader in general, unless you are trading a specific edge to do with fundamental analysis on news announcements or something, if you're just doing technical trading, avoiding times like this can save you so much money. Because there's 2 ways we can look at this. Say we have a sell order in here. We have a sell order in here. So the market brand, we're trading back on this bar. We have a sell order in here. The market breaks below that. Okay, we get into a trade. Move it a bit lower. And then we get it close, almost get our sell order placed. Market bounces up and then rockets down. Now, there's a good chance that before our trade is even placed, that this market will be well below this level. We have to be very careful in order to make sure that we aren't affected by this type of slippage. So avoiding news announcements can be a huge benefit to your trading, and waiting for areas of medium volatility in the market. Times like this where you have high volatility can be dangerous. Say again, on this bar, if we entered a long position and our stop was the blue line, well, all of a sudden, when the market rockets down, it can skip right past our stop and then get us out of the trade could be 10 or more points below where we wanted it, causing us a much larger loss on our trade. And slippage like that can be an absolute account killer. So we want to balance ourselves and always be mindful of news announcements that cause high volatility and low liquidity situations. That's one of the scariest and worst times to trade, when there's high volatility and low liquidity. There's not enough people to take the opposite side of your trade, and there's a lot of price movement in the market. I hope this gave you a better understanding of volatility versus liquidity in the markets. Do you have any trading topics that you'd like covered? Leave a comment below and we can dive deeper into all things trading. If you just enjoyed the video, please subscribe or leave a like.